market and push the price lower. Similarly, when the price touches the lower trend line, the buyers push the price higher. That's why breaking above or below the trend lines shows which side has taken control. Breaking above the falling wedge in an uptrend indicates continuation to the upside. Similarly, breaking below a rising wedge when we are in a downtrend indicates the price intends to continue to the downside. Now, considering the market direction, we can identify 4 types of wedge patterns on the chart. But for the sake of this video, we will only talk about the falling wedge in the bull market and the rising wedge in the bear market. The reason is that trading these two will make much more sense since we will be trading along the dominant trend. Falling wedge pattern in the bull market. This pattern indicates a period of correction in a bull market where we have a clear moving uptrend. Now, how can we use this pattern to enter the market? Breaking above the falling wedge in an uptrend signals the start of the continuation to the upside. It shows that the buyers have finally overcome the sellers, and since our direction is bullish, the price can continue pushing upwards. But sometimes these breaks are nothing more than fake breakouts. After breaking the upper trend line, the price will return and continue trading inside the range immediately. This will confuse traders who thought the trend line was broken and entered a long position. So how do we identify true breakouts? Here are some tips to improve the performance of wedge patterns. First of all, we need a proper trend line to show where our rejection area is. We draw the trend lines from the wicks and the area where we can get the maximum number of touches. We wait for a candle to clearly break and close above the trend line. For further confirmation, we need the price to break above the previous market structure as well. This rule confirms that the market has enough momentum to push to the upside. After this break, we will look for entry reasons to open a buy position, but sometimes it is too late to enter the long position because if we set our stop below this swing low, we would have a large stop loss. Therefore, we need a pullback to enter at a better price. Rejections at the back of the trend line, the 61.8% Fibonacci retracement level, or perhaps finding a demand area, can be perfect opportunities to enter a long position. We have a similar concept about the rising wedge pattern in the bear market. This pattern indicates a period of correction in a bear market, where we have a clear moving downtrend. Breaking below the rising wedge in a downtrend signals the start of the continuation to the downside. It shows that the sellers have finally overcome the buyers, and since our direction is bearish, the price can continue pushing downwards. We wait for a candle to clearly break and close below the trend line. For further confirmation, we need the price to break below the previous market structure as well. Then we will look for short opportunities aligned with the dominant downtrend. Here on the Euro-Dollar 1-hour chart, we have a strong bearish trend. Looking at the left-hand side, we can identify this fair value gap, which is an extreme supply area. The market has already shown some reaction to this area, and it can provide a good opportunity to go short. However, let's zoom into a lower time frame to find more confirmation to enter a short trade. Here on the 15-minute chart, we can identify this wedge pattern which shows a period of correction for the higher time frame downtrend. Here we had a fake breakout to the upside, but the market immediately got back inside the range. In order to enter a short position, we need to wait for the price to break below the lower trend line and previous market structure to confirm that the sellers have taken control. If we open a short position right now, we would have a large stop loss since it must be protected above this swing high. So we need to witness some sort of a pullback to enter a short position at a better price. So we will apply the Fibonacci retracement tool from the start of the latest impulsive movement to the end and put a sell limit at the 61.8% level. Our stop will be above the swing high, and we would set a 1 to 2 solid risk to reward. Here on the gold 1-hour chart, we have a clear moving uptrend. The market has made a pullback, and now we must identify an area of demand to go long. Similar to the previous example, on the left-hand side, we can identify this small area of fair value gap which is already rejected by the price. Now let's zoom into the 15 minutes chart to look for confirmations. On the 15-minute chart, we can identify this wedge pattern, which has been broken to the upside exactly after the market has tapped into the 1-hour FVG. We also have this liquidity pattern, which has swept the stop losses below these equal lows. Now that we have a clear breakout, we can open a long position and set our stop below the swing low. Now let's continue with the second trading chart pattern, which is one of our favorites. A double top or a double bottom is a popular M-shaped reversal pattern that price action traders widely use. It happens when we have double rejections approximately from an area. Whenever this pattern forms on the chart, it simply shows that the price failed to create a new lower low, possibly due to various reasons like momentum loss, market structure shift, tapping into a higher time frame key level, and more. So there's a chance for the price to reverse from here or enter a phase of temporary correction. Now, the reason that this pattern is so important is that it can be used in combination with almost all of the concepts as an entry reason, which we will get into later. But now, how do we approach the market when this pattern forms? The most conservative way to trade this pattern is to wait for the price to break the neckline to confirm the reversal. But the problem is, if we enter the market after breaking the neckline, our stop will be too large. So the common way to trade this pattern is to wait for the price to pull back to the neckline and look for candlestick rejections to enter trades. But we could also miss the trade if we don't get a good candlestick formation. So there is another way to trade the double top and bottom, which is by combining with 61.8 Fibonacci retracement to optimize our trade entry. After breaking the neckline, we will apply the retracement tool from the start of the move to the end of the recent move, and place our buy limit order precisely at the 61.8 retracement level. The same concept applies to the bearish scenario. Price rejects a level twice and completes the pattern by breaking above the neckline. We use the Fibonacci retracement tool and place sell limits at the 61.8 retracement level. Our stop will be below the swing low, and we will target the next level of market structure. But here comes an important point. Trading every double top and bottom in the middle of nowhere isn't effective. The best way to trade this pattern is by combining it with smart money concepts. Forming this reversal pattern inside an SMC supply or demand area will make an excellent confirmation to enter the trade, especially if the second rejection acts as a liquidity sweep. Here on the Euro-Dollar 1-hour chart, we have a moving downtrend. Let's mark the previous bullish candles as the area of supply to look for short opportunities. Since we have a large supply zone, we need to zoom into the lower time frames to look for confirmations and enter the market at a better price. So first, we wait for the price to tap into the supply zone and zoom into the 5-minute chart to find confirmations. Here on the 5-minute chart, we can see that the market has formed a double top reversal pattern which shows momentum loss. Now there is a higher chance for the price to continue pushing lower along with the higher time frame. However, we would have a large stop loss if we enter the market right now. So we wait for the price to pull back to the neckline and enter the market if we see rejections. Here we have a long wick candlestick rejecting the neckline, which is our entry reason to enter a short position. Our stop will be above the swing high, and we will set a 1 to 2 solid risk to reward. Now this setup is not limited to this technique, and you could use multiple price action entry reasons to place the trading opportunity. But the important point here is that to calculate the results and build the confidence to trade your setup, you should do your own backtesting on multiple pairs. Number 3. Ascending and descending triangles. Now, this pattern can signal both trend continuation and reversal. It is one of the most unique chart patterns because of the psychology behind it. The ascending triangle goes like this. We have multiple rejections from a resistance area, but looking to the downside, we can draw a specific bullish trend line that also rejects the price to the upside. In other words, the market creates multiple higher lows while we have only equal highs. Now, what is the psychology behind this pattern? Although it seems like the price cannot break the resistance, every time the price drops, the buyers jump into the market earlier and push the price higher, which is a sign of their strength. Now, breaking above the resistance area shows that finally, the buyers have managed the breakout, and the price can push to the upside along the dominant uptrend. However, forming this pattern after a long-term uptrend can signal exhaustion, as the buyers cannot break the resistance area after multiple attempts. So when the price breaks below the trend line, it signifies a possible reversal. For further confirmation, we need the price to break below the previous market structure as well. This rule confirms that the market has enough momentum to push to the downside. After this break, we will look for entry reasons to open a sell position. But sometimes it is too late to enter the short because if we set our stop above this swing high, we would have a large stop loss. Therefore, we need a pullback to enter at a better price. The same thing goes for the bearish scenario, the descending triangle. Price is being rejected from a support area, and we can identify a trend line that shows the bearish momentum by creating multiple lower highs. Similar to the bullish scenario, breaking below the support shows that finally the sellers have managed the breakout, and now the price can push to the downside along the dominant downtrend. But how can we make sure that this is a true breakout and not just a fake out or liquidity sweep? In the case of a fake out or liquidity sweep movement, the price usually immediately gets back inside the range. So a conservative way to trade this pattern is to witness a clear breakout and wait for a pullback followed by a rejection from the support which has now turned into resistance. On the other hand, forming this pattern after a long-term downtrend can signal exhaustion as the sellers cannot break the support area after multiple attempts. So when the price breaks above the trend line, it signifies a possible reversal. For further confirmation, we need the price to break above the previous market structure as well. Here on the gold 15-minute chart, we have a moving downtrend. We can identify a descending triangle pattern as the price is trapped inside the trend line and support area range. So we have a fight between the buyers and sellers. Now, we can see that the price has clearly broken the support to the downside, which shows the bearish momentum and signals the bearish continuation. After this break, support becomes resistance and possibly provides us with a short trading opportunity. Our entry reason to open a short position is this bearish engulfing candlestick, which is another confirmation. Our stop loss will be above the engulfing candle, and we set a 1-2 target. Here on the $-yen 15-minute chart, we can also identify a descending triangle pattern. Now, the price breaks the trend line to the upside, showing that the buyers have overcome the sellers and signals a possible reversal. However, for further confirmation, we need the price to break above this strong resistance to confirm the reversal. After that, we can look for buying trades with confidence. Let's see what will happen. Now we can see that this break was nothing more than a fake out, and the price has broken the support area to the downside. Then it continues the dominant downtrend. So guys, that's it for this video. I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.